Hello everyone. Welcome back to Prime Accounting Classroom. In today's lesson, we're going to talk about an essential tool every successful business uses, budgeting. Whether a business is small or large, budgeting helps managers plan the future, control expenses, and ensure that the business remains profitable. In this video, we'll cover the key concepts of what a budget is, planning and control, advantages of budgeting, master budget, sales budget, capital budget, budgeted income statement, cash budget. By the end of this lesson, you will understand how businesses use budgets to manage their finances effectively. Let's begin. 1. What is a budget? A budget is a financial plan that estimates a business's future revenues and expenses over a specific period of time. That period may be a month, a quarter, or a year. In simple terms, a budget answers three important questions. How much money do we expect to earn? How much do we expect to spend? Will the business make a profit? Think of a budget as a roadmap for a business's finances. It helps management decide where money should be spent and where costs should be controlled. For example, a small retail store may prepare a yearly budget estimating sales revenue of $100,000, cost of goods sold of $60,000, operating expenses of $25,000. From this plan, the business expects a profit of $15,000. Without a budget, the business would be operating without a clear financial direction. 2. Planning and control. Budgeting plays two major roles in business management: planning and control. Planning means deciding in advance what the business wants to achieve and how it will achieve it. When preparing budgets, managers estimate future sales, production levels, expenses, investments. This allows the company to prepare for the future rather than reacting to problems when they occur. For example, if a company expects sales to increase next year, it can plan to increase production, hire more employees, purchase additional inventory. Control involves comparing actual results with the budget. After the period ends, managers compare actual results versus budgeted results. If there are differences, management investigates the reasons. For example, budgeted sales, $50,000. Actual sales, $40,000. The company must ask, why were sales lower? Was it due to lower demand? Marketing problems? Pricing issues? This process helps businesses correct mistakes and improve future performance. 3. Advantages of budgeting. Budgeting provides several important advantages to a business. 1. Better financial planning. Budgets help businesses allocate resources efficiently. Management can decide how much money should go to production, marketing, equipment, salaries. 2. Cost control. By setting spending limits, budgets help businesses avoid unnecessary expenses. Managers become more careful with spending because they know the expected limits. 3. Performance evaluation. Budgets allow management to measure performance by comparing actual results with planned results. This helps identify efficient and inefficient areas. 4. Coordination between departments. Different departments must work together to achieve the budget targets. For example, the sales department estimates demand. The production department plans how many units to produce. The purchasing department buys the necessary materials. Budgeting ensures that all departments work toward the same financial goals. 4. Master budget. The master budget is the main financial plan of the entire business. It combines all the individual budgets prepared by different departments. The master budget usually includes sales budget, production budget, capital budget, cash budget, budgeted financial statements. In simple terms, the master budget provides a complete financial picture of the company's future operations. Think of it as a collection of all the budgets that guide the company for a specific period. 5. Sales budget. The sales budget is usually the first and most important budget prepared by a business. It estimates the number of units the company expects to sell and the revenue it will generate. The sales budget is important because many other budgets depend on it. If sales increase, production must increase. If sales decrease, production and purchases may also decrease. Example: a company expects to sell 5,000 units of a product at $20 per unit. Sales revenue equals 5,000 times $20 equals $100,000. So the sales budget is $100,000. This information helps other departments plan their activities. 6. Capital budget. The capital budget focuses on long-term investments in assets that will benefit the business for many years. These assets may include machinery, equipment, buildings, vehicles, technology systems. Capital budgeting helps businesses decide whether an investment is worthwhile. For example, a company may consider buying a machine costing $50,000. Before making the purchase, management must ask, will the machine increase production? Will it reduce operating costs? Will the benefits exceed the cost? Capital budgeting helps ensure that businesses invest their money wisely in long-term assets. 7. Budgeted income statement. The budgeted income statement is a financial statement that estimates the company's expected profit for the future period. It is similar to a regular income statement, but it is based on budgeted figures instead of actual results. Typically includes sales revenue, cost of goods sold, gross profit, operating expenses, net income. Example, sales revenue, $120,000. Cost of goods sold, $70,000. Gross profit equals $50,000. Operating expenses equals $30,000. Net income equals $20,000. This statement helps management determine whether the business is expected to be profitable. 8. Cash budget. The cash budget estimates the cash inflows and cash outflows of the business during a specific period. In other words, it shows how much cash the business expects to receive and how much it expects to pay. This is extremely important because a profitable business can still fail if it runs out of cash. The cash budget includes cash inflows, cash sales, collections from customers, loans received, cash outflows, payments to suppliers, salaries, rent, equipment purchases. Example, beginning cash, $10,000. Cash inflows, $30,000. Total cash available, $40,000. Cash outflows, $25,000. Ending cash balance, $15,000. This helps businesses ensure they always have enough cash to meet their obligations. Conclusion. Let's quickly summarize what we learned today. A budget is a financial plan that estimates future income and expenses. Budgeting helps businesses with planning and control, allowing them to prepare for the future and evaluate performance. We also discussed several important budgets, including the master budget, which combines all budgets, the sales budget, which estimates future sales, the capital budget used for long-term investments, the budgeted income statement, which estimates future profits, and the cash budget, which plans cash inflows and outflows. Together, these budgets help businesses manage their resources effectively and achieve financial success. If you found this lesson helpful, don't forget to like the video, subscribe to the channel, and turn on the notification bell so you never miss an accounting lesson. In the next lesson, we'll take practical business examples and prepare budgets step by step, including a sales budget, cash budget, and budgeted income statement, so you can see exactly how budgeting works in real business situations. Thanks for watching, and I'll see you in the next class.